Greetings. These are challenging times in the economy and the markets, and therefore it's time for another CrashWatch video because all sorts of classical indicators are lining up as precursors to a major stock market crash. And I spoke about the other factors leading to a crash in earlier CrashWatch videos from last week and the week prior, which include this video up here, as well as this video up here. The Federal Reserve is tightening. They have stopped quantitative easing and are about to raise the Fed funds rate, which is exactly what they should not do. And the Wu-Xia shadow rate, which I explained in those videos, is also rising steeply, which always portends to a market crash. But now there is yet another factor working against the markets, and a crash may already be underway. It may happen in a matter of months, weeks, or even days. And that's a tremendously good buying opportunity if you have mostly cash right now, but if not, you may want to prepare accordingly. The factor that has emerged is that oil prices are rising quickly against market trends, which adds additional pressure onto the economy and therefore the stock market. So over here we have the S&P 500 SPY ETF, and I spoke about the head and shoulders pattern that we saw before. Left shoulder head, and now this right shoulder is forming. And this was happening even before oil prices spiked. This is because of the Federal Reserve's tightening of quantitative easing, which they should not be doing, as I've explained many times, but this is what they're doing. And this portends to a market crash. If you take a 5-year chart, the stock market could crash all the way down to this level perhaps, the low 3,000 in the S&P 500. There's some people who think a correction has already happened. No, this is just the beginning. There's about this much distance yet to fall. However, now when we add the oil factor onto there, so I go back to, let's say, a 6-month chart, and I add the oil ETF USO, which is a rolling ETF of oil futures, US West Texas Intermediate Oil, WTI oil futures. Now, in the last 6 months, it was kind of within one zone, and now it's just shot up. That is because the Biden administration in the United States has discouraged hydraulic fracturing and has discouraged U.S. domestic oil production, which caused some oil price increase, which then in turn emboldened oil-producing dictatorships such as Russia, which then went on to invade Ukraine. Remember, they annexed a piece of the Ukraine in 2014, which was the last time oil prices were high. Then he didn't do much for the next 7 or 8 years, and now he has gotten bold again because oil prices are high, and that means the strength of Russia's economy is seemingly high because of that. So oil has risen even though the market has been falling. Now, normally oil is a fantastic hedge for the stock market because it does not rise that much when the market rises, but it falls substantially when the market falls. So outside of situations like this, oil can be a great hedge. Let me show you in the 5-year chart. So the light blue line is oil futures, and the dark blue line is the S&P 500. And as you can see, whenever the S&P 500 falls, oil falls by more, and it doesn't recover quickly either. So it's a very good hedge, except for times like now. In late 2018, oil fell more than the stock market. In early 2020, because of COVID-19, oil fell much more than the stock market. Oil prices even went temporarily negative for a short while, and it didn't recover that much either until this situation now. Now oil prices are rising even without the stock market following suit, and the stock market decline, conversely, is not causing oil to fall. So now we have an aberration. And when is the last time something like this happened, and what did it tell us? Well, this happened in 2007 and 2008, so we'll go over there. This is a chart from mid-2007 until the end of 2009. And light blue again is USO, oil, and SPY, the S&P 500. So oil kept rising, 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 and rising, all the way up to what at that time was a record high, $147 a barrel, which it's still not at right now. And because oil was rising so much, it caused a tremendous amount of pressure on the trade deficit of all oil importing countries, on consumer spending and consumer confidence. People saw gasoline getting more and more expensive. This negatively affected their confidence. So then oil started to fall, and then the stock market was taken down with it. And this was the big stock market crash of late 2008. You can see that the stock market fell about 50% from mid-2007 to the end of 2008. And oil had risen about 150% before falling maybe 90% from that point until oil was also a net negative. So oil rising without the stock market following suit and rising against a gently declining stock market is something that is very analogous between 2007-08 and today. Think about the implications of that. Oil has to rise to such a point, and the high cost of oil has to percolate through the entire system to the extent that consumer confidence gets low, inflation gets higher than people would like. The Federal Reserve then tightens in reaction, and there's a big crash and all kinds of dislocation and disruption and a lot of stress in people's lives. All of this was not necessary. Like I said, every finding of my research is contingent on one thing, which is that the government cannot screw things up too badly. Things were going just fine until the Biden administration came in and began to discourage domestic oil production, causing the oil price to rise, strengthening a dictatorship like Russia as well as other places like Iran and so forth. Russia invades Ukraine, oil prices rise further, and that is going to cause a market crash as well as make it harder for the U.S. economy to absorb the quantitative easing that the Federal Reserve does. Since the Federal Reserve doesn't understand this, they are going to tighten. And this is not a partisan thing either. Republicans are equally culpable for this because they did not do enough to make the case about how the best thing to happen in the last decade for the U.S. economy and for even the world economy was U.S. domestic oil production through hydraulic fracturing. Every oil importing country had a major benefit because of that, because the cost of their imports became half. Many countries went from trade deficit to trade surplus, and all sorts of unsavory regimes were greatly diminished in power, and now those regimes are becoming stronger again. Some of the blame also lies with the Federal Reserve. No one at the Federal Reserve, despite having the pulpit that they have and the platform of media attention that they have, the chairman of the Federal Reserve or even any one of the other governors could simply say that all domestic inflation is simply because of a decrease in domestic oil and natural gas production. If oil and natural gas production resumes, then whatever temporary inflation that we're seeing will also go away, and that's the truth. However, they don't come out and say that for whatever reason. Either they don't understand it or they don't want to run afoul of some other political agenda, which is part of the problem because our system then has a major weakness. People who are supposed to be only aligned with the economy, the Federal Reserve, are deliberately not saying common sense things that are obvious because the political dimension is something they cannot risk getting involved in. And when politics pervades everything, then even non-political institutions cannot normally function. The Federal Reserve should have been able to say that a decrease in domestic oil and natural gas production is the entire reason for domestic inflation and oil and natural gas price increases. That is all they had to do. But now that we see we are getting into a 2007-2008 situation again. Oil is rising higher and higher despite the stock market not rising, and normally oil would decline as the stock market starts to decline, but now oil can only decline substantially when there's a major stock market crash that pulls the whole thing down. And the probability of that happening in the near future is rising because now this is another bearish factor piled on to everything else. The Federal Reserve is tightening. They're tightening because of inflation, but the oil price increase contributes more inflation, and therefore a number of things are working against the stock market as we speak. It's going to be volatile times ahead, and things could get ugly sooner than people think. But that is what I wanted to elucidate in this video and perhaps teach you how to think about these things and how unusual this situation is. Not since 2007, 2008 did we have a situation where a large oil price increase was met with a declining stock market, indicating that the oil price is not really going to go down until the stock market declines much further and forces it down with much more brute force effect. So some food for thought for sure. If you like this type of content and find these types of videos to be informative and of practical use for you, I encourage you to upload this video and subscribe to this channel. Thank you very much for watching.